Korea's banks, for example, wouldn't be such a bad thing. The Korean Financial Services Commission has been talking about unilaterally imposing these kind of measures since at least last fall. I don't have inside knowledge about how seriously they've been talking about it, but I know they've been talking about it. But the FSC has yet to take significant action on this front. I think it is past due time for Korea to lead by example in this area. Issue number 2 is the reform of capital requirements, the need to force banks to hold more capital and to make the capital adequacy regime more anti-cyclical as well. I think the importance of that was underscored by the crisis. Actually, if you go back 30 or 40 years in U.S. history, we've repeatedly seen that the bank's capital gets wiped out in crises. For me, that's prima facie evidence that they don't hold enough, and they should be provisioning for crises by holding more capital rather than forcing the taxpayer to do it for them. So the April 2010 G-20 communique at least paid lip service to the need to, quote, improve both the quantity and quality of bank capital for banks to hold more of their own funds and not only peculiar convertible kinds of Tier 2 capital. But the communique was lacking in specifics other than saying we can wait a while to gradually phase in these reforms. I think full implementation by the end of 2012, as promised in the communique, seems dangerously late, especially if you look back at past history and realize that deadlines like those are apt to be delayed. Issue number 3 is the cross-border resolution authority or cross-border protocols for dealing with institutions that are too big to fail. So one approach that we had been talking in this country about pursuing was a $50 billion fund to pay for the costs of winding up large, complex financial institutions that are insolvent. That is now, I guess, out of the Senate bill. What's still in, if I understand the debate correctly, is discussion of some kind of modified bankruptcy procedure for big bank holding companies, akin to what the FDIC does for banks narrowly defined. So, to be clear, I'm all for that idea in principle. It would just be lovely if we in the United States could wind up the Citigroups of the world when they become insolvent. The problem with that idea, among others, is that big financial institutions operate in multiple jurisdictions. At a minimum, we need a cross-border resolution protocol specifying who is in charge of winding up what using whose resources. So if you followed the Lehman Brothers fiasco, you will recall that there were then and there continue to be all kinds of problems between the Brits and the Americans and the shareholders, stakeholders in the different countries about who has claim to what and whose money needs to be kicked into the pot to wind up the institution. So I'm not arguing at this point for the need for some kind of global bankruptcy regime to wind up complex international financial holding companies, but I am arguing that we need at a minimum a clear set of protocols for how to proceed. And here again, I think the Korean authorities and the other G20 members have fallen down by not, to this point, having developed the relevant protocols. Finally, issue number 4 is exchange rates and global imbalances. So we can debate how important global imbalances were in the genesis of the crisis. I'm sure everybody in the room has his or her view. To be clear, my view is that global imbalances played a significant but probably subsidiary role in the 2008 2007-2008 crisis. I think fundamentally what caused the crisis was lax supervision and regulation and skewed incentives in U.S. financial markets. So that kind of was the match that set off the spark that caused the fire. And then two things added more fuel to the flames. One was an overly accommodating monetary policy in this country. In 2003, 2005, we now see that clearly with benefit of hindsight anyway. And cheap foreign, increasingly official finance, Asian central banks buying U.S. Treasury bonds and agency securities, resulting in lower interest rates and more stretching for yield on the part of financial market participants than would have occurred otherwise. So I guess my view is that if global imbalances hadn't been so pronounced, the crisis, there would have been a bit of a housing bubble, and there would have been a bit of a crash. But everything unwound much more violently and disruptively when you added more fuel to the flames, when Mr. Greenspan did it, and in China, Mr. Zhao did it. So the danger now is the reemergence of those self-same imbalances. If we now see U.S. Sustained recovery in the United States, investment picking up here, and a stronger dollar, those are all elements that could contribute to the reemergence of that same old problem. So what to do about it? In a nutshell, my answer would be don't become fixated on the exchange rate, as people in the Beltway are within the Beltway are when you think about this problem. The issue isn't really about exchange rates. Rather, it's properly about the policies that determine exchange rates. So the exchange rate, the real price level adjusted exchange rate, which is what economists think is important for is one of the relative prices that determines the allocation of resources. That's a variable whose level is determined by the markets. The policies that determine it are things like the level of consumption and saving in the United States and the level of consumption and saving in Asia. So in my view, what we need is faster progress in China and in Asia generally in boosting consumption, and faster progress in the United States in boosting saving, government saving. That's, code for dealing with the budget deficit problem in particular. The problem being that both sides are reluctant to move in the absence of evidence that the other side is moving. You would think that the G20 would be the ideal venue for reaching agreement on that kind of grand bargain, but its communiques said disturbingly little about the issue. So what can Korea and other Asian countries do if they have to proceed unilaterally? I think they can change the policy mix. More spending in China and elsewhere on things like the social safety net can encourage more consumption. If more spending in places like China creates the danger of inflation and overheating, monetary tightening is the appropriate treatment. And I think that's exactly the kind of adjustment that's not only called for, but is occurring right now in China. A small problem is it's not occurring everywhere. It's not occurring elsewhere in Asia. And I would note the reluctance of the Bank of Korea to move, to tighten. It may tighten after the elections in June. We will see. So to conclude, the strength of the G20 process has been that it really reflects the emerging architecture of the global economy, the political realities of the 21st century. The weakness of the G20 is that its chairs have not always been idea generators, good agenda setters. Korea has provided some good ideas, notably, I think, on the bank tax, but it's failed to achieve results. Maybe more results will emerge over time. We will see. Korea could also have done more, I think, to lead by example by addressing things like the capital inflows problem and the policy mix. So inevitably, my conclusion is that the record so far is mixed. So let me stop there.
Thank you very much.